There's something strange that happens when you start investing. You think you're being careful. You think you're being smart. You're reading the news, watching what's happening in the markets, staying informed. And somehow, despite all that effort, despite all that attention, you end up more anxious than when you started. Your returns aren't terrible, but they're not what you hoped for either. And you can't quite figure out why. I've watched this happen for decades now. Good people, intelligent people making what they think are sensible decisions, and those decisions feel right at the time. They really do. There's logic behind them. There's a reason. Ask someone why they sold a stock or bought a new fund or moved money around, and they'll have an answer that makes sense. But when you look back 5 years later, 10 years later, those decisions that felt so right often turned out to be exactly wrong. The thing is, nobody sets out to make bad investing choices. Nobody wakes up and thinks, well, today I'll do something that will hurt my future. It doesn't work like that. The mistakes that matter, the ones that really cost you over time, they don't feel like mistakes when you make them. They feel responsible. They feel like you're taking control. They feel like exactly what a thoughtful person should do. And that's the trap right there, that feeling of doing the right thing. Think about when the market drops. Not a little dip, but a real drop, the kind where you open your account and see red everywhere. Your stomach tightens up. You feel this urge to do something. Indeed, owing something feels like the smart move. It feels irresponsible to just sit there and watch your money disappear. So you sell. Maybe not everything, but enough to feel like you've protected yourself. You move into cash or bonds or something that feels safer, and the relief is immediate. You feel like you've taken action, like you've been prudent. But here's what happens next, and it happens it's almost predictable. The market keeps dropping for a while, and you feel validated. See, you think, I was right to get out, and then at some point, the market starts climbing back up, but you don't get back in right away because it still feels uncertain. It still feels like it could drop again. So you wait. You wait for things to feel safe again. You wait for confirmation that it's real. Okay, to invest again. And by the time it feels safe, by the time you're comfortable putting money back in, the market has already recovered most of what it lost, maybe all of what it lost. You missed it. You missed the recovery because you were waiting for it to feel right, and the math is brutal. You sold low because it felt responsible. You bought back in high because it felt safe, the exact opposite of what works. I think about this a lot because it's not a knowledge problem. The people who do this, they know the old saying about buying low and selling high. They've heard it 1,000 times. But knowing something and being able to act on it when your stomach is churning, when the news is terrible, when everyone around you is worried, that's entirely different. The trap isn't in you, our understanding. It's in how things feel. And it's not just about market drops. The same thing happens when markets are going up. Everything's rising, your portfolio is growing. You're hearing about other investments that are doing even better. Maybe it's some sector you're not in, or some new kind of fund, or some stock everyone's talking about. And you start thinking, well, maybe I should be in. That too. It feels like you're missing out. It feels like you're not being aggressive enough. So you shift things around. You chase what's already gone up because it feels like that's where the momentum is. And sometimes, for a little while, it works. The thing you bought keeps going up and you feel smart. You feel like you made a good call. But more often than not, by the time something feels Lee, an obvious winner, by the time everyone agrees it's a great investment, most of the easy gains are already behind it. You're arriving at the party late, paying full price for something that's already expensive. And when it eventually falls back to earth, as most hot investments do, you're sitting there with a loss, wondering what happened. The pattern repeats itself in different forms. Tim. It's getting out of an investment that's been flat for a while because you're frustrated with it. Sometimes it's avoiding an investment that seems boring, even though it's solid. Sometimes it's putting too much money into whatever's been working lately. The details change, but the core is the same. You're making decisions based on how things feel right now in this moment with all the emotions, ND pressures of this moment, instead of thinking about what actually works over long periods of time. And the strange part is the things that actually work, they often feel wrong. Holding on to stocks when the market crashes feels reckless. It feels like you're ignoring obvious danger. Buying more when everything's dropping feels crazy. It feels like catching a falling knife, like throwing good only after bad. Sticking with a boring, diversified portfolio when there are exciting things happening elsewhere feels like you're being too conservative, like you're not taking advantage of opportunities. But time and time again, those uncomfortable choices, those boring choices, those patient choices, they're the ones that work. Not because there's something magical about discomfort, but because good investing is usually about resisting your impulses. It's about not doing the thing that feels urgent. It's about recognizing that the feeling of needing to act is often exactly when you should sit still. I remember in the late 90s, everyone was talking about internet stocks. And I mean everyone. At parties, at family dinners, in line at the grocery store. People were making money, money, and they were making it fast. And if you were sitting there with regular stocks, with companies that made actual products and had actual earnings, you felt like a fool. You felt like you were missing the future. The pressure to jump in wasn't just from greed. It was from this feeling that everyone else understood something you didn't, that staying out meant you were behind, that you were making a mistake. And of course, when it all came apart, when those stocks crashed, the people who had felt foolish for staying out, they were fine. They were more than fine. The people who jumped in because it felt like they had to, because it felt irresponsible to miss out, they lost a lot of money. Some of them lost most of what they had, not because they were dumb, but because they let the failing of the moment override everything else. The same thing happened in 2008 with housing and financial stocks. The same thing happened in 2020 and 2021 with all sorts of investments that felt like sure things. It keeps happening because the trap never really changes. What changes is the story we tell ourselves about why this time it's different, why this time the feeling is justified. There's this other side to it too. It's not just about the dramatic moments, the crashes and the manias. It's about the day-to-day wear and tear of paying too much attention. Every day you check your portfolio, every article you read, every opinion you hear, it creates this pressure to have an opinion, to have a view, to make adjustments. And if you're checking every day, well, you're going to see things every day that make you want to do something. One day a stock is up and you think maybe I should take some profits. The next day it's down and you think maybe I should cut my losses. One week the news is good and you feel confident. The next week the news is bad and you feel worried, and all this noise, all this information, it doesn't actually help you make better decisions. Mostly it just gives you more opportunities to make decisions based on feelings instead of based on what actually matters. What actually matters is so much simpler than we make it. It's about owning good businesses at reasonable prices and leaving them alone. It's about having a diversified portfolio that you can live with in good times and bad. It's about not paying too much in fees and taxes. It's about being paid. But simple doesn't mean easy, because simple feels passive. Simple feels like you're not trying hard enough. We've been taught our whole lives that effort leads to results, that if you work harder, you do better. And in most parts of life, that's true. But in investing, a lot of effort often leads to worse results because every action has costs, and most actions are driven by exactly the wrong feelings at exactly the wrong times. The people I've known who've done really well over the long run, they're not the ones who are constantly adjusting their strategy. They're not the ones who had strong opinions about what was going to happen next month or next quarter. They're the ones who found something sensible and stuck with it through the boring times when nothing much happened, through the exciting times when it felt like they should be doing more, through the scary times when it felt like they should run away. And I'll tell you, those scary times, they're the real test. Because when you're sitting there and the market has dropped 20%, 30%, and you don't know if it's going to drop more, everything in you wants to protect what's left. It's not illogical, though. It's deeper than that. It's survival instinct kicking in, telling you to avoid danger. And the danger feels immediate and real, while the long term, the eventual recovery, that feels abstract and uncertain. But if you look at every major market decline in history, and I mean every single one, the people who stayed in did better than the people who got out. not because they were braver or smarter, but because they understood that the feeling of danger and the reality of danger aren't the same thing. The market dropping feels like losing money, but you only actually lose money if you sell, if you hold on, if you wait it out. The market has always eventually recovered and gone higher, always. There's no guarantee that pattern continues forever. Nothing's guaranteed, but it's worked for a very long time across all sorts of terrible circumstances. And yet when you're in the middle of it, that history doesn't help much, because this time feels different. It always feels different. The specific crisis is new. The specific fears are new. And so it feels like maybe this time it really is different. Maybe this time staying in is the mistake. And some people get out and they feel and then they feel regret. There's something else that happens too. Even if you don't sell, even if you hold on, the stress of watching your money disappear takes a toll. You lose sleep. You feel anxious. You check your accounts more than you should. And all that stress, it comes from caring too much about the short term, from treating temporary drops as if they're permanent losses. If you truly believe that you were investing for 20 or 30 years, would you really care what happened this month? Would you even look? But we do look. We can't help ourselves. And every time we look, we're tempted to react. We're tempted to do something, because doing nothing feels passive, feels irresponsible, feels like we're not taking care of our money. But in investing, doing nothing is often the hardest and most valuable thing you can do. It's an action in itself. It's the action of not letting your feelings in this moment override your strategy for the long term. I think the reason this trap is so powerful is because it's reinforced by everything around us. The financial news needs you to believe that daily movements matter, because that's what keeps you watching. Investment firms ed you to believe that active management and constant adjustment adds value, because that's what justifies their fees. Other investors need you to believe that their activity is smart, because that's what justifies their own behavior. Nobody wants to believe that the best approach is often the boring one, the patient one, the one that doesn't require much skill or effort, just discipline and discipline is the hard part, not the discipline to work hard or to study more or to find better information. The discipline to sit still, the discipline to ignore the noise, the discipline to let time do the work instead of trying to do it yourself. That kind of discipline goes against everything we're taught about success. It goes against our instincts. It goes against what feels right. So people keep falling into the same trap. They keep making decisions that feel smart and turn out to be costly. They keep acting when they should be patient. They keep looking for safety at exactly the moment they should be willing to take risk. They keep chasing performance after it's already happened instead of before. And none of it feels like a mistake. It all feels justified. You know what's interesting? The same patterns show up in people who think they're being contrarian. They'll see everyone buying something and they'll say, well, I'm going to do the opposite. I'm going to be smart about this. And sometimes that works. But just as often, it's the same trap wearing a different costume. Because being contrarian for the sake of being contrarian, that's still letting your feelings drive the destiny. That's still reacting to what everyone else is doing instead of focusing on what makes sense for you. Real independence in investing isn't about doing the opposite of the crowd. It's about not caring what the crowd is doing. It's about having a plan that makes sense for your situation and sticking with it regardless of whether other people agree or disagree, whether they're excited or scared, whether they think you're being too aggressive or too conservative. None of that matters. What matters is whether your approach is sound and whether you can live with it through all conditions. And living with it, that's where most people struggle, because any reasonable investment approach is going to have periods where it doesn't feel good, periods where you're underperforming what someone LSE is doing, periods where you question whether you made the right choices. And in those moments, the temptation to switch, to try something different, to do what's working for other people, that temptation is enormous. But switching is usually the mistake, because by the time you switch, by the time whatever someone else was doing looks good enough that you want to do it too, that strategy is F10 near the end of its good run. And your old strategy, the one you abandoned because it wasn't working, that's often near the beginning of its good run. So you end up switching from something that's about to do well to something that's about to do poorly. And then a few years later, you switch back and you do it again. I've seen people spend their entire investing life switching from one approach to another, always moving toward whatever worked recently, always moving away from whatever's been struggling. And they end up with returns that are worse than if they just picked something reasonable at the start, never touched it. The switching costs them, the bad timing costs them, the stress costs them, and they never quite figure out that the problem isn't their strategy. It's their inability to stick with any strategy. There's a deeper thing happening too. When you're constantly making changes, constantly reacting, constantly trying to optimize, you never learn what actually works because you never give anything enough time to work. You never see a full cycle. You never experience what it's like to hold through the uncomfortable parts and come out the other side. You just keep resetting, keep starting over, hoping that the next thing will be easier or better or more comfortable, but nothing's comfortable. That's the part nobody wants to hear. If you're going to invest in stocks, you're going to have periods where your account value drops significantly. That's not a bug. That's how it works. The higher returns you get over the long run, that's compensation for being willing to sit through those drow. If you can't sit through the drops, if you get out when things get uncomfortable, you don't get the returns. You get the stress of the drops without the benefit of the recovery. And bonds aren't a perfect solution either. They're less volatile, sure, but they have their own problems. They don't grow the same way stocks do. They have interest rate risk. They get eaten by inflation over long PE periods. There's no perfect investment that gives you high returns with no discomfort. It doesn't exist. So you have to pick your discomfort. You have to decide what kind of volatility you can live with and build a portfolio around that. Most people don't think about it that way, though. They think about maximizing returns. They want the highest return possible. And then when the volatility shows you when the inevitable drops happen, they can't handle it. They weren't prepared for it emotionally. They didn't realize that the returns and the volatility are connected. You can't have one without the other. So they end up in this cycle where they want stock-like returns but can't handle stock-like volatility. And they keep trying to find some way to have both, some strategy or fund or approach that will give them the upside without the downside. And they waste years and money looking for something that doesn't exist. Or they find something that looks like it has no downside for a while, and then it blows up spectacularly because the risk was always there, just hidden. The honest answer, the answer nobody wants to hear, is that you have to match your investments to your temperament. If you can't sleep at night when your portfolio drops 20%, then you shouldn't have a portfolio that can drop 20%, even if that means lower returns, even if that means someone else might do better. Because a lower return that you can stick with is worth more than a higher return that causes you to panic and sell at the worst time. And that's hard for people to accept because it means admitting limits. It means saying, I can't handle as much as I thought I could. It means maybe settling for good enough instead of optimal. But good enough that you actually do is better than optimal that you abandon halfway through. If there is one thing I'd want someone to understand about investing, it's that your feelings are not your friend. The urgency you feel, the fear, the excitement, the certainty that you need to do something right now, those feelings are usually pointing you in the wrong direction. They're designed to protect you from immediate danger, and that worked great when the dangers were physical and immediate. But in investing, the dangers are long-term and the opportunities are long-term, and your feelings are optimized for exactly the wrong time frame, the time. So when you feel most certain, most confident that you're right, those are often the times when you're about to make a mistake. The times when you feel most uncomfortable, most uncertain, most like you should do something, those are often the times when doing nothing is exactly right. It's backwards from how we think things should work, but it's how they actually work. And look, I'm not saying you should never make adjustments. I'm not saying you should set up a portfolio at 20 and never touch it until you retire. Life changes, your needs change, your situation changes. Sometimes adjustments make sense, but the adjustments should come from changes in your life, not from changes in how you feel about the market. If you need money in 5 years instead of 20, okay, that's a real reso. To be more conservative, But being more conservative because the market dropped, or because you are worried, or because something feels wrong, that's the trap talking. The investors who do well aren't the ones who never feel fear or excitement or uncertainty. They feel all of it. They just don't act on it. They've learned, usually the hard way, that those feelings pass, that the market's gyrations are temporary, that patient capital compounds in ways that busy capital never does. They've learned that the price of good returns isn't intelligence or effort. It's patience and the ability to feel uncomfortable without doing anything about it. And maybe that's the real lesson. The most dangerous traps in investing aren't the ones that feel dangerous. They're the ones that feel safe. Selling when the market crashes feels safe. Buying what everyone else is buying feels safe. Move to cash when you're worried feels safe. But safety is often just another word for locking in whatever damage has already been done and missing whatever recovery comes next. Real safety in investing comes from being diversified enough that no single thing can destroy you, being patient enough that temporary drops don't force you to sell, and being honest enough with yourself to know that you're not smart enough to predict what happens next. None of us are. The people who think they are, the people who act like they are, they're usually the ones who end up learning expensive lessons. So maybe the answer is simpler than we want it to be. Maybe it's about finding an approach you can live with in good markets and bad, setting it up and then getting on with your life. Maybe it's about SPE. Less time thinking about your investments, not more. Maybe it's about recognizing that the feeling that you need to do something, that urgent sense that action is required, maybe that's not insight. Maybe that's just fear or greed dressed up as wisdom. The trap feels right because it's designed that way. It's designed by our own minds, our own instincts, our own need to feel in control. But investing isn't about control, it's about participation. You participate in the growth of businesses over time, and you let that growth work for you, and you try very hard not to get in your own way. That's it. That's the whole thing. Everything else, all the complexity, all the activity, all the feelings of certainty and urgency, that's just noise. And the hard part, the part that determines whether you do well or poorly, is learning to hear that noise for what it is and not letting it convince you to act against your own interests.